Welcome back, folks. It is Friday, and I'm a happy camper. I hope you are, and I hope you're safe wherever you are. We're going to be talking a little bit right now about unusual activity. So, just as I get that last fill in, let's get to it, shall we? So, unusual activity, also known as 3 at 3. This is where every day, for free, I give you 3 of our picks where we have seen unusual option activity. I define that as following the smart money. Smart money, people that can afford all kinds of research. They have commission dollars to pay for it. They also have a lot of trading dollars behind every trade they make. So we're not talking about a $15,000, a $20,000 trade. Even though those, for some of us, those are big trades. We're talking about $200,000, $2 million, $20 million. Those kind of trades. That's the real smart money, folks. All right, let's get to it. 3 at 3. You want to learn more about it? You can go to marketrebellion.com. That is marketrebellion.com. You can see all about our coaching, our mentoring, our distance learning, where you can basically open up your computer or your laptop or your iPad and sit there and go through various tutorials about option trading, stock trading, futures trading, cryptocurrency trading, all of that available at marketrebellion.com. And what I'll be talking about right now, Market Rebellion /UOA, or unusual option activity. Also, this disclaimer, our services that I'm providing for you right now are for informational and educational purposes only. I am not your financial advisor. You guys have to figure that one out for yourselves. All right, let's get to Stitch Fix, SFIX, Stitch Fix. Why? Well, because we've seen this, as you see on your screens there, folks, repeatedly. SFIX has been a frequent flyer on unusual option activity, or UOA, as you see just in the past week. I mean, look, last Friday, when the stock was $17.30, they were buying the May 16 calls. They cashed out of those. Then they bought the May 17 calls, cashed out of those. Bought the May 19 calls, cashed out of those. They moved on up, and now they're buying the June 23 calls. So, as I always try to do, June 23, what does that mean? That means that they're buying an option that expires a month from now. That's one bit of information. Second bit of information, above the market. Where is the stock trading right now? Well, when we posted it, when Pete was on the halftime report, I believe it was trading about 21.68, because that's what it says on the screen. Where is it right now? A little over 22 bucks. It's been over 23 today. So watch this one, folks. 8,000 of these calls for $4. So let me define something else for you. By the way, you might notice there too that they sold puts, June 20 puts. In other words, that would give somebody the right to shove stock into their account at 20 bucks a share, because the seller of a put has obligations. The buyer of the put has rights, just like the buyer of the call has rights. So why did they do this trade? Well, they're bullish on the stock. They think it stays above 20, and it cuts down the cost of their ownership of those June 23s, because they collected $2.25 for every one of these June 20 puts that they sold. So what I would pay attention to also, folks, is that these are fairly expensive options. June 23s trading for $4. That's why, just like I did with DraftKings, if you are a buyer of those calls, the June 23s, I would sell a call above it. That's what I would do, not advice for you. So that's what I would do. I would buy those June 23s and sell maybe the 25s or the 26 or whatever against it, because then I'm cutting down the cost of my ownership without increasing the risk. This is why, partly why it's so bullish for us, is that this trader increased their risk. In other words, if this reverses on him or her, and goes to the downside, this trader not only is chasing to the downside and experiencing pain, but this trader is also getting a leveraged bet that the stock stays above 20. I don't know if a lot of you want that much more risk in your account. So instead, what I would do is buy those 22s or 23 calls and sell a higher strike against it, 1-to-1, because that has a cut to the time decay, which is theta. It also puts me in a position where vega or volatility doesn't hurt me as much either, because volatility compression would hurt in the case of this one. And this is Stitch Fix bearish put roll up. So watch it. All right, next one. There's Stitch Fix. Take a look at this, VNQ. VNQ, September 80 calls. They were buying these and rolling them down. They're buying the SEP 80s. They're selling the SEP 85s. That's a $5 bull call spread. So watch this one, folks. September 80s against 85s. They're doing that for right in the neighborhood of 80 cents, 75, 80 cents. That worth watching, VNQ. And there's VNQ right now. As you see, earlier in the week, it was 75. Now at 68, they're getting a little bit more bullish on it. Lastly, HPQ, and I'm doing these kind of quick because I got to rush off to an appointment. HPQ, take a look, bullish call buying 55,000. That's 55,000. That, my friends, is 5.5 million share equivalent. So watch this. They're buying the July 17s with the stock at 14.55. They bought 30 of them in a single print. That's 3.4 million share equivalent. And they paid 45 cents up to 63 cents. That's a big trade, folks. So watch this one. 14.55 to 14.80 is where the stock was during the time that they were buying these. And again, they've traded over 55,000 of them. What does that stock look like? Looks like that. Just this week, you've seen it move up from about the 13.40 level up to 14.88. And what are they buying? They're buying the July 17 calls. I am Jon Najarian, folks. You can find out more about all of what I've spoken about at marketrebellion.com/UOA for unusual option activity. That is marketrebellion.com/UOA. I hope you have a safe and a very happy weekend, and I'll see you next week back here on Market